3, 2, 1.
All right.
Welcome to the show.
Middle of January. Here we go.
It's going to be freaking March tomorrow.
Dude, I can't wait. I'm sick of this weather already.
Yes, no, Boston boy.
I know.
Getting soft.
I know. Yeah, well, that's okay. I'm going to get softer. I'm going to keep moving south. I'm not moving.
Yeah,
I mean,
there you go.
Boston's awesome in the summer. There's like no better place. But for about 3 months on a good year. So anyway, a lot of good stuff this weekend. We had CPI on Thursday, PPI on Friday. Not a whole lot of movement in the market really at all because of those two. January tends to be pretty flat anyway. I mean, we're gonna look at a chart of it, but the in the fourth year of the presidential cycle, the election year, when there's an incumbent president, the market is supposed to go up in January, has a little bit of correction in February, March, and then supposed to keep rallying through the end of the year. So that's kind of the base case, but January hasn't. January basically has been following the path of a non-sitting president or an open election, which is kind of interesting. But we'll get to that. So some pretty interesting stuff going on, really, in 401k, TSP kind of space. The Secure Act 2.0 came out in 2022. We're going to talk about that a little bit. And if you're a retired guy, you definitely want to kind of pay attention to that piece. Then the January Trifecta we'll talk about. I got a bonus chart and then the TSP fund charts. So new required minimum distribution rules came into effect in 2022 when they passed the Secure 2.0 Act. So there are some major changes in there. They apply to qualified retirement plans, which TSP is a qualified retirement plan, 401ks, 403bs, TSP, and IRAs. So the act gets voted in 2022. Bunch of changes in there for how we save and are taxed in retirement. And so one of the biggest is helping individuals save for retirement is reforming the minimum distribution rules. So new rules especially significant for employees who are in their late years of federal service and getting close to retiring from federal service. Important for these employees to know the new TSP required minimum distribution, that's RMD. Required minimum distribution rules will impact them in order to better plan for retirement. So this is definitely part of the retirement planning piece as you're, say, mid-60s and looking what you're going to do with TSP money going forward. So prior to the Secure 1 Act, TSP participants had to start taking minimum distributions by April, which is the required beginning date. I don't know why they do that. So many stupid acronyms. But our RMD is required minimum distributions. RBD is required beginning date. Okay. So in the first version of the Secure Act, you had to start taking required minimum distributions by April 1st, either the year that you turned 70.5 or when you retired from federal service, whichever was later. Okay. Under the Secure 2.0 Act, it's now a two-step process. So for employees born after December 31st, 1950, so basically January 1st, 1951, April 1st, following the latter of the year, you become age 73, right? Not 70 and a half, 73. And employees born after, 1960, it's April 1st, the later of the year you become 75 or retire from federal service. So they pushed it basically from 70 and a half to 73 and 75. Okay, so you got a couple more years before you have to start taking required minimum distributions. So here's the big thing about that now for people. Some people probably already know this, but there's an IRS penalty for not taking required minimum distributions from an IRA or TSP. The IRS penalty is a 50% excise tax on the distribution shortfall. So if you don't take your required minimum distribution the government takes half of what you were supposed to take as an excise tax. That is unbelievable. It's possible that you might eat that and still come out ahead if you're at the top of one tax bracket and you have to take a minimum distribution and it's big enough and it's going to push you up into the next tax bracket and you don't want to take it. I mean, if you have that much in your account and you're that into focusing on this stuff, it would probably make you bang your head against the wall that the government's taken half of your
absolutely.
thing.
Well, this is where you just have to have a financial planner that's
yeah.
got all this mapped out so that you know exactly what you have to do, what your impact is. This is not investment advice.
No.
It's financial planning.
Yeah. Absolutely. And obviously it's for when you're, in your 70s. So you get a couple more years that you don't have to take distributions, so you can generate more in your TSP that way. And then once you have to start taking them, the distributions, I mean, you just have to do the tax planning.
Yeah. They're making you take it.
Yeah, they're making you take it. And if you don't take it, they're going to take it. They're going to take half of it.
That's crazy.
Yeah. And it's not all of your it's just the required distribution. So it's based on the actuary tables.
Half of your RMD.
Yeah. But still, half of
I don't want to give them half of anything.
Right. I
don't want to give them $50.
Yeah. So anyway, the good news is the Secure 2.0, the current 50% excise tax is one of the stiffest in the entire IRS code. It's no surprise, therefore, that many members of Congress wanted to reduce the penalty. And that is why it's going down. Not because they care about you guys. It's because they themselves, people in Congress, want to reduce that penalty. So the Secure 2.0 Act reduces the penalty to 25% in all cases. And this is from a myfederalretirement.com article that just came out. Unbelievable. Okay. So if you're in that category, definitely read up on that article. There's quite a bit more in there. And Roth, there's some different rules for Roth. So definitely take a look at that article. All right. The January Trifecta, also known as the January Barometer. So it's been tricky so far. The January Trifecta is the Santa Claus rally, which is the last 5 trading days of the year and the first 2 trading days of the following year. That's the first piece. The second piece is the first 5 trading days of January. We just finished that. And then the third piece is January's closing price. And then the saying goes, as goes January, so goes the year. So if January is a down month, the year tends to be, is more likely than usual to be a down year, put it that way. Santa Claus rally, the market was down 1.03%, I think, at the end of the Santa Claus rally, so that was negative. First 5 trading days of the year, the market was down like 0.3%, more or less, so that was a negative. And so now we're waiting on the closing price of January. And of course, there are all kinds of statistics that go along with that. So all this is from Stock Traders Almanac. Jeff Hirsch runs the Stock Traders Almanac. He's got a Tumblr. What's Tumblr like? Not podcast, but posts, basically.
Tumblr?
Yeah.
So I didn't know it still existed.
Yeah, he's kind of old school. But it's if you go to Stock Traders Almanac.
Yeah, it's one of the first kind of blog.
It says blog.
Yeah.
And you hit on blog.
And Tumblr.
Yeah.
That's kind of funny.
Yeah.
He's probably the only one keeping it alive.
Quite possibly. So anyway, this is Santa Claus rally. So if you have a down Santa Claus rally, right, going back to 1950, he's looking at the numbers going back to 1950. So these are all the down Santa Claus rally years, and he did not include this year, obviously. But when the Santa Claus rally doesn't happen, right, it's negative. So these were all the amounts negative that year. And then this is by the end of the year, this is where, this is what happened. So obviously in here, there are plenty of really positive years, okay? Tons of them. But there are an abnormal number of negative years, okay? So I really don't like statistics, basically, and especially averages, because if you're basing your trading on the Santa Claus rally in 1980, let's say, and you got a minus 2.2% for the Santa Claus rally, you're in a place where you're looking to be out of the market that year. But it had a almost a 26% return by the end of the year. But on the other hand was 2008, right? About the same, 2.5% decline, but the market's down 38.5% for the year. So statistics, especially averages, I just don't like them because it's like flipping a coin. It's 50-50. Even if you flipped it 100 times and you get heads every time, the 101st time it's still 50-50. Okay, so that's what just the Santa Claus rally looks like. So the second part is the first 5 trading days. FFD calls it first 5 trading days. When that's down and the Santa Claus rally is down, okay, but the January barometer is up, meaning January finished higher for the month, okay. So in this case, 1985, let's say, Santa Claus rally failed, was down 0.6%. First 5 trading days were down 1.9%, but by the end of January, it was up 7.4%, right? And then the full year went on to 26.3%. So he's got these up here to show that, number one, it's not very often that you get a negative Santa Claus rally, a negative first 5 days of the month, and a positive January. It just doesn't happen very often. So going back to 1950, 2024 would be the 4th time. So it doesn't happen very often. That's the positive. The negative is when the January barometer and the first 5 days and the Santa Claus rally are all negative. Okay, that's basically the worst way you can go into the year. And we'll wait to see what happens at the end of this year, but at the end of this month. But there are still, here in 1982. Even with all 3 of them being negative, you still finish the full year at about 15%. So just because the January trifecta fails doesn't mean that the whole year is going to fail. It just means that, when that condition exists, when the January trifecta is negative, you're much more likely to have big down years. Okay? And the up years are really muted. Right, you're up 2.5% here. This was an outlier basically at 15%. 9.5% here isn't bad, but it's nothing like the 20s and 30% moves that we have seen over the last 20 years. So again, 2024 could be something like this, or it could be something like this. You just don't know. And again, that's why I don't like stats.
Yeah, but I think it's good for us to, to have at least a baseline to work off of, meaning you kind of know what it's expected statistically for this year. So you go in with a little bit of bias. You don't want to be too biased about it because you don't want to be, you don't want to get it so emotional.
Right.
You get so biased that you become emotional and do emotional trading. But you do want to have it in your pocket to be aware, and so that's why I like it. Yeah. I like these sorts of historical statistics because it at least gives you a place to start from. Now we're just as quick to recognize that it is an anomaly and it's going to be a great year, and it's going to be on that list and it's going to have a high number and it's going to be like, oh, remember 24?
Yep, it can be.
It absolutely can be, but at least you know what the probabilities are like.
Yep. So you should not take away from this that we're saying that 2024 is going to be a terrible year.
Not at all.
All we're doing is reporting the news.
Exactly. Well, this is literally just facts.
Yeah.
That's it. And now you can take it for what it's worth, but you definitely want to be aware of this.
Right.
Because if you go into this with all sorts of crazy, inflated opinions based on what you hear on the news or something, they're not quoting this stuff. Generally speaking.
No, not usually on.
No, because it's
CNBC.
boring. Yeah. It's boring, but it's facts, and they know it. They know it just as well as we do, right?
Yeah.
Because
they pull up Jeff Hirsch every once in a while. Especially at the end of the year, they bring him on to talk about the Santa Claus rally and what that is, because his dad was a legend, and so they bring him on and they talk about it. And a lot of people talk about seasonality. There's a lot of different ways to look at seasonality, and the next chart is actually going to be much more bullish than the data that Stock Traders Almanac puts out. So they're kind of conflicting. So basically, if we had the Santa Claus rally, that's negative. First 5 trading days are negative. If the whole January barometer ends up being negative, it's just statistically a challenging year. Okay. And again, the average. So you could have been at 15% here or minus 38% here, but the average is minus 3.6% for the year. So if you do like averages, you're working against it this year. On the positive side, I can't remember if we've done this chart in the newsletter. I don't know if we've done it on the podcast, but this is a chart also from Stock Traders Almanac. The green line is a sitting president. It's the fourth year of the presidential cycle, so it's the election year when a sitting president is running, which is what we have right now. The first couple months are really strong. You get a pullback, February into March, maybe early April, and then it's kind of flat until the summer, and then the summer it really starts kicking up. So most of the money is made in the second half of the year under the best circumstances. If you can get this, first couple of months gain and get out, and then wait this period, and then get back in, say in July, that's probably the best kind of seasonal way to look at it. So, and again, it's going back to 1950. So this seemingly has failed because January has been down to flat. I mean, we went down, we came back up. We're talking about the S&P 500. We're basically where we were at the beginning of the year. So it's looking much more like we're following this kind of pattern than this pattern. Okay, because this is the percent change. So we're in the middle of January, and we're nowhere near a 2% up move. We're at 0. So we're much more in line with this pattern so far, right? This piece. And if that continues, we're basically flat. Could we get the dip in March? Sure, we're basically flat. Really, I mean, this is moving up, but basically until July. July is where, no matter what, July is where the rallies really should start happening. So, and again, it's averages. So this is the average percent change in the election year. So it doesn't look like we're having this, which is good. It's obviously not an open field. So basically the reason you have this pattern, which significantly outperforms by the end, is because there's a lot of money tends to get pushed into the system because whoever the incumbent is using whatever tools they have, which is all of them because of the sitting president, to get people elected, themselves probably included. Okay. Bonus chart. So MSTR, a lot of talk about Bitcoin, right? The Bitcoin ETFs just got approved this week. They've been talking about it for months. It's going to be a huge deal. All the big financial institutions have been on the sidelines because they can't invest in Bitcoin because there's no, you'd have to either buy the Bitcoin or do it through Coinbase or, some of the others. But there's no Fidelity Bitcoin ETF, right? There's no Schwab Bitcoin ETF. So they just, you sent me that, it was Grayscale. Were they the first ones that got an ETF?
As far as I know, Grayscale was the first one. I don't know if anybody else has gotten approved yet, but
yeah, it's definitely coming.
And it's supposed to be almost immediate. Like they were ready.
Yeah.
So it's gonna be on the exchange like quick.
Yeah, which is great, and it's going to enable a ton of money to get put into Bitcoin, and then the rest of the crypto space, I'm sure is gonna come right behind it. So MSTR is a company called MicroStrategies. Guy's name's Michael Saylor. That owns a company. I can't even remember what his company does, honestly, but he transfers all of the value of his company to Bitcoin. So he doesn't hold the value of his company in dollars. He holds it in Bitcoin, which makes ticker symbol MSTR a way to play Bitcoin without buying Bitcoin but you're buying a company that basically tracks it. So this is MSTR, and if you overlaid a chart of Bitcoin on it, it would be very similar to this chart. And so it was basing back here, had this huge run up, and then it has collapsed quite a bit, right? Going forward here, they started talking about the Bitcoin ETFs. Huge run up. And you don't really see it on this chart unless you're looking at the numbers, but back here, it's $100. Up here, it's $1,300. I mean, 13 times your money. Pretty good. And then it came all the way back down to about 150 at the beginning of 2023. And then up to 750, right? This run is an expectation of Bitcoin ETFs. And then right when they come out and they say we're going to do the ETFs, what happens? This is the best example of buy the rumor, sell the news I've seen in a while. It's pretty unbelievable. So everybody's all excited up here because you got this huge move, and they're going to, the ETFs are coming, all this money's going to pile into the market, and it may eventually, but the first move based on all that was clearly to the downside. So this is what it looks like if you were going to, obviously big, huge, wild swings, and if you bought back here, you are not happy, right? If you bought anywhere in here, you're good. So obviously, if you buy at support levels, you're in good shape, right? As the support levels go up, no problem. Buy it at support levels. So if you go forward, this is going back to July of last year. If you wanted to buy MicroStrategies, which basically Bitcoin, right? The ADX line. So these four indicators: ADX, relative strength, CCI, and MACD. Okay. You'd have to focus on it, right? Because it's big percentage moves, right? You're talking about up here at $720 at the end of 2023. So at the end of December, it's $720, and now it's $500 as of this morning when I put this together, right? So that's a huge move down. But it also has huge moves up, right? So when you got a breakdown in RSI, the buyers leaving, the sellers coming in, CCI is rolling over, and MACD is rolling over, it's a great time to sell it, right? Because the buyers are leaving. Relative strength is declining. You just had this big run up. Take your profits and go away for a while, okay? The market comes back down. You're watching it. You're waiting for RSI to get down here at the 20 level, right, to get close to oversold. Once it gets there, now you're looking, okay, the buyers are starting to, or the sellers, the red line, the sellers are starting to leave. The buyers aren't coming in yet, but the sellers are leaving, and the relative strength is improving. Okay, the CCI is improving. You got a low of CCI down here, and price kept going down, but CCI started moving higher. So things are changing under the hood, right? Once you get a break above the moving average in RSI, the buyers, the green line, goes up through the sellers. That's a buy. Okay? It didn't hold. The buyers and sellers went flat for quite a while, right? About 6 weeks. You could hold through that, or you could sell it. But either way, you're still watching, because when you get to that transition point again, you just get back in. And so you might take little gains and losses along the way here. But if you can catch these big transition points, you're making, if you bought it down here at 360 and you own it up here at 680, you're just doubled your money, right? So great. So when do I get out? When the buyers start leaving, right, and the sellers start coming in, even as this churn is going on at the top, that's your indication that something's getting ready to go. And once they cross, right, I would do it here when RSI breaks below that line. RSI is down, CCI is down, and MACD crosses right there. So you certainly could have avoided this. You probably would have gotten out on that day. But anyway, that's how you would do it. And Bitcoin's going to be super volatile going forward. If you drew some Fibonacci levels to here, I've been playing with this all morning, so kind of bear with me. But this is obviously a good support level. It could certainly find support there. But as long as the buyers are going up, the red line's going up and the green line's going down, I'm not going anywhere near it. But CCI is oversold, right? It doesn't happen very often, and it doesn't stay down very often for very long. So if you are interested in trading Bitcoin, this is a good way to do it. And it's super volatile. You got to watch it. Okay, TSP fund charts. So C fund, this is a weekly of the C fund. Okay, we just talked about ADX line. That's that. This is an indicator called McClellan oscillator. I'm going to do a blog post about each one of these actually in the next couple of weeks. But basically, if you just use price, which is this, and the ADX line and the McClellan oscillator, okay, just those two. Here's those three. Here's what you would be looking at. You got this rally in price, right? Which means buyers are coming into the market. That makes sense. Sellers are leaving. But the McClellan oscillator is starting to roll over. Okay? When the McClellan oscillator goes negative, that's your first indication that something's up. So the reason I put this line, I mean, it doesn't have to be that weak, but when sellers are leaving, buyers are leaving, sellers are coming in, and the McClellan oscillator has already turned negative, and you have a big move down in price, that's a pretty good buy signal, or sell signal, rather. So that's right before COVID, right? So you'd have avoided the whole COVID loss. Eventually you get to the bottom, and the sellers are leaving. The buyers are coming in, and you get a positive cross in the McClellan oscillator. So yeah, you didn't get in at the bottom. You got in right here. And you got this huge move through 2021. Right? With just these two indicators. Then you got a cross again, right? Buyers are coming out, sellers are coming in. McClellan oscillator had already crossed. It was early, right? So as price keeps going up, you're kicking yourself because I got out too soon, right? But as long as the McClellan oscillator stays negative, the top is imminent, which it was right there, right? So you got out a little bit early. You saved yourself this whole move down into 22. McClellan oscillator triggered a little bit early. The sellers start leaving. The buyers didn't start coming in yet, but the McClellan oscillator is telling you they're going to be. They're telling you this is a bottom. Okay? So that's how you, on an ongoing basis, kind of look at it. And then where we are right now, again, this is a weekly chart. So we had that bottom in October last year. You got the oscillator just turned negative. Okay, negative 5.2. You got the sellers just starting to tick back up, and the buyers, let's say, flat. So I'm watching this. If you're on a weekly basis, you should be looking at this saying, okay, McClellan oscillator just went negative on a weekly basis. That should be a big red flag. And once this 18.49 number gets over 20, the market comes down. Okay, because the red line is moving higher, and the sellers are going to be moving down at that point, and the price will move down. It can go the other way. You can see that there are some head fakes in the McClellan oscillator. It's a tool, just like everything else. There's no guarantees. But that's the setup where we are right now in the C fund on a weekly basis. F fund. I use the ADX line here and relative strength. So instead of McClellan oscillator, I use relative strength, but it's the same kind of analysis, right? Going into COVID, we had a big run up. You got buyers coming in, sellers going out, and then we got relative strength, came down in a hurry, buyers leaving, sellers coming in. I mean, that was a pretty clear sell week. Turned around real quick, right? So it's kind of a one-off. Obviously, COVID was kind of weird, but out of that, you got buyers coming in, sellers going out until they cross. At the same time, relative strength crosses down through the trend line of the relative strength. That was a great place to sell the F fund. Price comes down quite a bit. Buyers are at an extreme low. Sellers are above 40 at an extreme high. That's probably a low. When sellers get up here at 40, that's probably a low. So now sellers start coming down, buyers start coming in. Relative strength crosses to the upside. That's time to buy it. Okay. Sometimes you get big moves down or big moves up. Sometimes you don't make or lose too much. That's the way the price goes, but the technical indicators are definitely the thing to follow. And then if you add in the Elliott wave count to that, this was the top right here. So this is the 1, 2, 3, 4, 5. Everything was oversold. This was a great time to buy in the F fund. Okay. All right. That's the kind of stuff that we do on the subscriber side. We do it on more on daily charts than weekly charts, but if you guys are interested in that level of analysis, definitely check us out at growmytsp.com.
Questions. As always, if you have questions, put them in the comments section wherever you find the video. If there is no comment section, you can send us an email at support@growmytsp.com, and the support team will get it over to us, and we'll answer it the best we can.
Yep.
Hope you guys are having a great weekend, and hope you have a great week coming up. If you like the show, please share it with your friends. If you don't, share it anyway.
They might like it.
Exactly. All right. You guys have a good one. We're out of here.
Out of here.